Jay and I are delighted to be with you here today on our quarterly presentation with regard to the federal tax legislative developments, which there have not been as many this time as before, but I think it is still worthwhile that we be cognizant of how things are potentially moving. And of course, the bottleneck is still the bottleneck. Biden's gotten the construction bills out, and we're still reaching for other things. Now, that doesn't mean that those other things are not there. Doesn't mean that there is no path forward to achieve those. But by the same token, it is going to be a stretch. And Congress has provided a bottleneck, including the Democratic Party, has provided a bottleneck to the president achieving what certainly he set out to achieve at the time of his inauguration. I'm going to turn things over to Jay to get things started and talk about where we have been recently, and then we can get into some more questions of where things are likely to go. So, Jay, all yours.
All right, thanks, Mel. So basically, where we are is in unknown territory. And what I mean by that is everyone wants to move tax legislation. There are several tax provisions that have bipartisan support. The big one being allowing people to expense R&D. Another one to broaden the 163J interest deduction. There are also tons of green energy provisions that probably could get all Democrats to support them. But what bill can it ride on? And the reason that's an issue is because the Senate, as we've said a million times, is evenly divided. And to pass a bill with just Democratic support, you have to have the vote of the vice president on there, and you have to have special rules for that bill to get through the Senate. Also, the House is no cakewalk. The Democrats in the House, they control that chamber, but they do it by 5 votes. And the partisanship, how political people are, be it far left or medium left, is basically evenly divided. So even within the Democratic Party, there are disagreements on what should and should not happen because they're just entirely different. It's basically 2 different parties within the Democratic umbrella. So it's not good. And they are now looking at opportunity zones, and this is from the far left side of the Democratic House, that they want to try to figure out how to rework the zones so they apply to different areas within the country. And they're trying to do this by executive order because they can't do it through regulation or through legislation, and it just doesn't seem to work. But that is one of the things that has been brought up. And of course, the question becomes, how are you going to move it? How do you think this is going to move? And so that is the biggest thing that comes out when you hear tax increases. How will you move it? And that's kind of unknown. So before we start with what's going on now, last year, nearly 5 months ago, was the last time tax legislation moved through the House. And that's the one that is the Build Back Better bill. That's the one that has all the tax increases that aren't rate increases. And that came to a grinding halt when Senator Manchin said on December 19th, I will not support this legislation. Now, when he said that, people were saying, well, is it dead? Is it dead? And he really didn't answer it. Well, he finally answered it, and the answer was yes. That bill that passed the House is dead. Now, don't construe that with the tax increases in that bill being dead, but just the overall bill is dead. And so whatever comes forward with Build Back Better, it will not look like the House bill. And that's just food for thought. But it's it took a while for Manchin to admit that finally, and he did earlier this year. So here are what's included in the House reconciliation tax bill. And one thing I'd like to point out to you is the cap on the state and local tax deductions. It's on the top of the line. This is something that even though Republicans hate tax increases or tax anything, they created this. And they created it in the 2017 tax reform bill. It's not 80,000, it's actually 10,000, and this is the current limit. This was an expansion of the current law to go to 80,000. And this provision is probably going to be extended no matter who's in control of Congress, because first of all, Republicans who generally don't like tax cuts or tax increases created this for political reasons, and Democrats who actually really want to like remove this, there's not enough of them to actually do it. Once again, the party is divided into two, and you can literally divide them with the pro-salt and the con-salt groups. And the people that are against this say it's for the wealthy. $10,000 is fine. Most of my constituents are renters, and so why are we doing this anyway? And so that's one thing that could be seen in every piece of legislation ever done, because it raises money, and that's what lawmakers are always going to want to do, is raise money. The other thing to look at, and I don't know if you can see it, it's I went up too far. It's at the very bottom, it says IRS funding. Now, IRS had its funding. They got an increase, and they're very happy about that, but it's not near enough. And Commissioner Redding will tell you that every single day, because he tells every reporter every single day it's not enough money. But you likely will see the IRS getting more money no matter who's controlling of Congress. And the reason for that is because Republicans want a more efficient way of dealing with taxes. And they think it's automation, which means we could actually give you more money to automate, and then you guys could have to fire a bunch of people that we don't need anymore, and therefore you will need less money to do more down the road. Democrats want more money for the IRS to crack on the wealthier businesses, the pass-throughs. And so both parties want more money for the IRS for very different reasons. And based upon who's in control, you're going to hear that reason, but you might see more money coming to the IRS in the near future, because lately they haven't been getting much. And so I think that is you, unless I missed something here.
Nope, that's that. Oh, there we go. That's me. And here to pick up and follow on the statement that you attributed, quoted from Senator Manchin, the bill that passed the House is dead. Okay, I think that pretty much that does describe the situation with regard to the House bill. There has been significant discussion, I think, as to whether or not, okay, if the Democrats can't do the full package that they set out to do, is there something, let's call it a Build Back Better light bill. I don't know whether we need a copyright next to the LITE spelling or not. I'm sure our attorneys will advise us on that. But in any case, could there be a Build Back Better light bill that still could be passed in 2023? And I've got to say that the outlook for that does not seem to be that good. We don't really know. The inability to satisfy Senators Manchin and Sinema was in large part the reason that the big reconciliation Build Back Better bill failed. And we don't really know what it's going to take to satisfy those two senators. How much of the particularly revenue, well, what's going to have to be eliminated from the original legislation to get them to come along, what might need to be added to the original legislation to get them to come along. And certainly, if the Build Back Better light becomes so light that it leaves on the cutting room floor the bulk of what the progressives were looking for when they supported President Biden, do they jump ship? I mean, this, I think, is the point that Jay raised with respect to, well, what happens. We always talk about the Senate, and because that was where the difficulty was with the legislation back at the end of 2021. But there is plenty of indication. And remember, you only need, what number is it, Jay? It's about 7 Democrats to jump ship on the House side.
Yeah, 5 Democrats.
5 Democrats now. And the legislation can't move through the House. So it's going to be a difficult slog to do anything, to do the light bill. And that even leaves aside the question of, geez, you know, what if this, does this really need to be revenue neutral? And if it does need to be revenue neutral, what do we include in the way of benefits? What do we include in the way of revenue raisers? And on top of this, I will say, and this is something that Jay and I have heard when we've spoken to several senior staffers with on the Democratic side. The Democratic leadership has not at least let the rank and file know that they have either the strategy or the tactics in place to make a Build Back Better light happen. Dick Durbin, the Senate Majority Whip, just flat said, I'm not touching that. And I think there's also a sense among the rank and file, and that's who we were speaking with in this case, that this cannot happen unless it's very clear who's going to negotiate with who can make the calls, who can make the deals. Because as long as there is an open ability of each member to step up and say, well, here's what I want, and here's what I want, and here's what I want, here's what I can't stand, then the chances that they really can pull something together are very slim. Now, let's make a leap of faith. Let's say strategy, tactics do come together. What could the Build Back Better light look like? Well, let's take a look at some of the things that they wanted to, some of the key items they wanted to spend money on. The child tax credit. This was the biggie for the Democrats. There are some concerns as to how far they can take this, but sort of the bottom, the low revenue estimate was at $95 billion. And depending upon how much expansion and how you interpreted some of the language that was in the House bill, which was not always perfectly clear, revenue estimates were coming in as much as $185 billion. Green incentives. There were up to $325 billion of green incentives in Build Back Better. The SALT cap, again, some question as to exactly what version of the SALT cap changes we might see, but up to $175 billion. And the one thing that it does seem everyone agrees on, which is to repeal the requirement that you amortize research and development costs, is itself $30 billion per year. All right. So what's on the what's acceptable on the table that could offset these costs? Well, there is still discussion, a lot of questions as to whether regular tax rates could be affected, but there does seem to still be some discussion of the millionaire surtax, and the original score for that was $228 billion over on the House side. But one problem, that's a 10-year score, and it assumes a permanent millionaire surtax in exchange for financing provisions that by and large were only going to be effective for 3, 4, or 5 years. If you And this was something that was very clearly pointed out in the debate on the Senate side. If you scale back to a closer match of the period that we would get the benefits with the period that we would be raising money out of the millionaire surtax, let's talk more, a little less than $100 billion. Still some pretty good money, but not as much as certainly the 228 that was in the original package. Take a look at all of the corporate and international provisions. Wow, and I mean, we're talking about all of them. $790 billion in the House bill, $790 billion of additional revenue over 10 years in the original House bill. But 300 billion of that is reflected in the financial statement alternative minimum tax, which I think we can say there is a general agreement is not going to make it into the Internal Revenue Code. And further, let's go ahead and compare apples and apples. And if we knock it back to 5 years, what was 790 billion is now only 127 billion. And that is everything that was in the corporate and international provision, except for alternative minimum tax, but only limited to 5 years. All right, you know, we've got numbers here. Let's play with some numbers. Let's say we take the 5-year millionaire surtax, and let's go ahead and claim half of the 5-year no AMT corporate and international. Okay, that gives us $154 billion to play with. How are you going to spend it? What's going to be the goodies in your light bill? Well, if all you do, no expansion in the child credit, but you extend what was added to the child credit in the Recovery Act, that's $95 billion right there. R&D expensing, we're probably going to have R&D expensing in some legislation that passes. Just 1 year, 30 billion. All those green incentives we talk about, we'll only take 5% of those. And the SALT relief, only 7.5% of that. And lo and behold, we've just spent all the money. And I think this is politically, it is fine to talk about. Well, we can still do it. We can still do Build Back Better Light. We had all this revenue. Well, but you sort of look at really, you know, what do you think we're safe in raising? How are you going to spend it? The math here is looking very, very difficult. And I think for that reason, there is now an alternative plan. And this is one that Jay has been following very closely. So I'm going to turn things back over to him to talk about an alternative way to get some tax legislation, to get some of these provisions that does not involve trying to actually get to Build Back Better Light. Jay?
Yeah, so basically what's going on is that Democrats in Congress are trying to add a tax provision or a few tax provisions to any bill that they think is going to eventually become law. And the biggest example of this is right now, the Senate just passed a bill called USICA, which is a semiconductor China trade bill. It has nothing to do with taxes. And the House has already passed what's called the Competes bill, which is it's the same idea with just different provisions, semiconductor China trade bill. And so now they have to bring together those two pieces of legislation, hash out all the differences, and then come to an agreement on one bill that both the House and Senate can agree to. Well, on the House side of that bill is a health coverage tax credit that has been extended and expanded. And it is literally just, why is a health coverage tax credit doing in a China trade bill? it makes no sense whatsoever. But the reason why they're doing that is because Democrats are trying to slowly put pieces of Build Back Better into other bills with the hope that those bills will pass, become enacted law, and then they will get some of the tax provisions from Build Back Better enacted into law. And so this is the first chance that they're doing that. This bill, I think they call it the Innovation Act, which actually doesn't have any title for the House and Senate, but it's just overall an Innovation Act. And they hope to have House and Senate leaders agree on a unified bill by May, maybe June. And this health credit could be a part of that bill. And if it is, it can get enacted into law and everybody's happy. The problem with this is a painfully slow process to enact dozens of tax provisions that were in Build Back Better. And how exactly are you going to do this? And so a lot of people that view this bill, that track legislation here in Washington, find this idea laughable that you all are really going to do this for every single thing. And obviously they just can't do it. So what's your choice? And obviously this health tax credit wasn't even controversial during Build Back Better. And so is there a problem with it? Are they trying to do the least controversial tax provisions? But basically what they're doing is sneaking tax provisions into bills that they think is going to be enacted. And this bill should be enacted. So I'm keeping my eye on it to see what actually happens, or will they add other tax measures to it? Normally you don't add additional provisions to a bill in conference between House and Senate leaders, but sometimes they do. So I'm just keeping an eye on it. But the one thing that I think should be noted is a tax benefit actually can be a sweetener, or it can actually gain support. So if you have a lawmaker who says, I don't like this bill, you could say, oh, well, we're going to have a tax provision in there that could satisfy some of your voters. They'll say, okay, I'll vote for that. Now, that's a great idea, but until they go too far, and when you add one tax provision into a bill, you have created what's called a tax title, and that means other tax provisions are germane for that bill. So the lawmaker could go, oh, I do like that we're going to repeal the SALT cap, but I'm actually more concerned about, tax X. Can we add that? And they're like, oh, well, sure, because why not? And what happens is that so many provisions come on that it weighs down the bill, because suddenly you have a progressive or a polarized lawmaker disagreeing with what the centrist lawmakers agree with. And SALT's a perfect example. They're like, what do you mean you're going to get rid of the cap? I'm not voting for that bill now. And so it's called the Christmas tree. And basically legislation that has too many tax provisions in it gets so heavy that it falls under its own weight and just can't move forward. So it's called a Christmas tree. And the funny thing is that the narrowly focused tax provisions are the ones that get the most support, because you're literally pinpointing something for someone. It's like, look, this will help your voters. That is the same exact thing that hurts support as well. So it has to be done very carefully how this is what you add to legislation when you do tax provisions, because it's like, hey, what about me? Or, oh, this is too much, this is too crazy. So the issue with the just approved omnibus bill, and Mel, is this yours or is this mine?
It's I think it belongs to either of us.
All right.
I mean, this was a situation where the omnibus legislation moved forward, and originally there was some intention or expectation that they would include tax provisions, and the result was no, they didn't. And I think there were a lot of reasons. You mentioned one of them here, that there was already bipartisan support because of the need to include the funding to support the Ukrainians. But also, I'd go back to the points that you made earlier with respect to how this affects any other bill. You put one tax provision in, and then everybody wants their tax provision in, and is upset if you don't add theirs, and suddenly you have a lot more tax weight than the legislation can carry.
Yeah, and this bill was supposed to actually cover the R&D expensing. It was supposed to be in this bill.
Yeah.
And the problem became like R&D expensing comes in, and then the Christmas tree effect happens. And so once you put one tax provision, all of them can go on. And there was even talk about putting extenders on this bill. And that's usually a year-end thing. And so it did become a problem, and they just had to get rid of it because Ukraine funding was really needed fast. And they couldn't allow this to just dither on the line like they do with most pieces of legislation. And so it just became a problem, and they had to cut the tax title out.
People talk frequently about, okay, well, we'll get our provision onto legislation because it's must pass legislation. I think the Omnibus actually is a pretty good example where, because it truly was must pass legislation, must pass now, extraneous things simply could not be accommodated. And so there's sort of a sweet spot of, quote, must pass, close quote, legislation. If it's too urgent, then leadership has to maintain the discipline of not adding things on, which is what we saw here.
Yeah. All right, so let me go down. There we are. Okay, so this is the other avenue. There should be about 5 different paths here for how many avenues there are for other tax provisions. But this is just showing that there's several bills that should be moving that could have tax provisions on them. The China trade bill is what I've told you before. That's the semiconductor bill. There is a COVID relief bill that they're actually trying to do, but there's a lot of it's uneasy because basically what the COVID relief bill is it's going to be paid for by COVID measures that were passed in the past, but not used. So they're going to take the unused money of COVID relief and offset it with new funding for COVID relief, basically saying, look, we've already spent this money. Why don't we just use this money again and give it out? Well, the governors don't like that. Lawmakers don't like that. And so this bill has kind of become unclear if it's going to move, just because the Democrats don't want to use unused funds. And so it's not really happening right now. The Build Back Better, which we've talked about forever, the clock is ticking on this. Currently, the Senate's dealing with the Supreme Court. They've got the China trade semiconductor bill going on, and they have a couple other things. And if Build Back Better were to be even discussed, we're talking June, July, maybe. And then at that point, what happens is September 30th is a congressional year end, and Build Back Better is a budget reconciliation bill. It's the budget for fiscal year 2022, which is what we're currently in. On September 30th, we no longer are on October 1st. We are now in fiscal year 2023, which means the budget for 2022 cannot pass, cannot do anything. So they either have to create a whole nother reconciliation bill, or this bill just dies. And so September 30th is when this bill cannot move forward. It fails, it just vanishes. And so that's why they're trying to maybe move it, but they have a lot more on their plate. And one thing that's happening is the retirement legislation that passed out of the House Ways and Means Committee literally a year ago. It passed by unanimous consent, and it's got taxes in it. It could do a lot, and there is talk about this bill moving forward. I've yet to see it happen yet, but all it really has to do, it passed the Ways and Means in March of 2021, was moved to the House floor, and now it waits. It's been waiting for a year. It's got bipartisan support, but of course, when they add things to it, which they can on the House floor, then maybe it becomes a Christmas tree. And so that may not happen, but it's something to look out for because it does have a lot of support. And also too, after the elections, the partisanship, there's a brief moment when the partisanship just dissolves and bipartisanship springs forward for about a month. And when that happens, you might be able to move legislation that normally wouldn't move. A tax extender bill always happens, usually happens at the end of the year. And that could be the place where the R&D expensing could happen, where the 163J expansion could happen. But all of that, and I think it's the next thing. Nope, but all of that moves forward if the child tax credit moves forward. It all is based on the child tax credit moving forward. And what I mean by that is the expanded child tax credit beyond what happened in 2017. That expansion has to happen again for anything else to move, because Democrats, a lot of Democrats on the far left are saying, we're not going to give business tax cuts if the child tax credit is not expanded. So that would be the 2017 rules that they want to expand from, not from the original, because the 2017 rules expire in 2026, but they're talking about even the expansion in the tax reform bill is not enough. They need more. And so that has to happen. And so Mel, I think you are next.
That, does raise the question of what if they don't do anything? Some things are going to be different, particularly on the business side. We've mentioned this several times before, but the requirement that you capitalize and amortize over 5 years your research and development expenditures is currently the law. This is something that's going to need to be retroactively changed. Again, the anticipation is that is one of the more likely tax legislative changes, but as we have sometimes seen, Congress certainly can take a while getting around to it, and sometimes it does not happen. So this is something to be keeping it. Similarly, the calculation of deductible interest. And we're talking about interest that is, completely business related, no question about the legitimacy of the interest, but there is a restriction on how much you can take, and that has previously been earnings before interest, taxes, depreciation, and amortization, the so-called EBITDA. But now interest is deductible up to 30% of only your earnings before interest and taxes. So you'd have to now reduce that number by depreciation, reduce that number by amortization, and particularly for those taxpayers where there is a significant investment in depreciable property, particularly where there is a significant investment in new property for the purposes of finally getting into the last couple of years of the full 100% bonus depreciation. This is going to raise some interesting changes that need to be made as part of your return on investment calculations. Again, this is something that many in Congress would like to see retroactively changed. On the other hand, I think this one is somewhat less likely than some help with regard to the research and development question, and is certainly something that we need to be conscious of. Let's see here. Now, as usual, Congress has allowed provisions to expire. The Joint Committee on Taxation, generally their first published pamphlet of each year is a list of the tax provisions that are going to expire within the next 5 years. You can go to their website, jct.gov, and print out your own copy. It's something worth, at least for looking at the current year, something worth looking, because there are 40 provisions that expired at the end of 2021. A lot of these are in the alternative energy and conservation area, but an important issue there is the ability to, if you have an investment in alternative power, renewable power facilities, the ability to claim an investment credit instead of a production credit, a credit that is paid out as you produce the electricity. That has now technically gone away. There are some healthcare provisions for individuals, the itemized deduction for mortgage insurance, and interestingly, some of the special support for troubled pension plans has now all expired. Will Congress come back at the end of the year and retroactively extend them? Certainly, Congress has shown a willingness to retroactively extend these items in the past. But do all of them get extended? Do some of them get extended? We don't know. The R&E provision, the requirement to amortize R&E, is probably the engine that ultimately drives whatever we see in the way of extension legislation and retroactivity with regard to the legislation. But there are always questions, and until Congress actually does it and the president actually signs it, these are always issues. A couple of other items to keep in mind don't affect 2022, but are certainly going to be on the table legislatively as we move into 2023. Remember the 100% business meal deduction that goes back to 50% beginning in 2023. And for those of you who are in the crypto world, including those of you who may be using crypto in any of your commercial activities, we're going to see some very expanded reporting requirements that are going to come into effect after 22, unless we see future legislation dealing with that. Tax provisions that are on the table, I think Jay pretty much summarized these. The R&D fix, the expanded interest deduction, the expiring provisions, the child tax credit. All of these four are ones that are more central in the attention of Congress. All of them are ones that we are actively watching to see if they can be dealt. But whether they are dealt with or not, many things have been done in the past years that frankly have increased the burden on the Internal Revenue Service, a entity that is still operating many times with technology that predates the Apple IIe. This has become a subject of interest on Capitol Hill. As Jay mentioned, there was some significant increase in funding for the IRS in the appropriations bill, not as much as the IRS was looking for, but still a substantial amount. But it's still going to be some issues. And Jay, you were you attended the hearings that this was very much front and center. Why don't you bring us up to date on what went on there?
I also want to share with you guys that I used to be on K Street, and the child tax credit is not on K Street. They don't care. What they care about is the R&D. What they care about is the 163J. They care about other business things. And so what you're seeing is K Street's money. They give money to lawmakers to do things. That's it. That's just what happens. And no one's giving the lawmakers money for the CTC. And so it's kind of interesting, like, that's what the lawmakers are saying has to go first, but no one's giving them money to say that. And so when you hear a lawmaker say that, it's because they actually wanted to move forward. not because they're being paid to say to move it forward. And so if you don't think money and politics are connected, oh boy, you know, this is how it works. But anyway, to the IRS. So the I probably don't even need to share with you guys the headaches of the current tax filing season. You guys are on the front lines. Amy, if I could get the control, because you guys you live this. Oh, let me go back up. And the problem with it is that the backlog is paper, and the paper keeps growing. And even though now they're trying to reduce it and they hope to have it done by the end of the year, there are other times when this has been talked about in the hearings, that an accountant was forced to use paper to submit something because they couldn't do it electronically, only adding more and more to the problem. And the problem is paper. And every witness, IRS commissioner said this, the main person, Aaron Collins, said this as well. And the union, the IRS union person said the same thing, like we cannot get enough paper out of the way to get this thing done. Now, Redding said in the last one, we are gonna clear this backlog by the end of the year. So let's hope it happens. But, you know, keep your fingers crossed. Now, one of the other problems that they have is hiring. And as this screenshot says, and this is from, it's called TICTA, but it's the Treasury Inspector General for Tax Administration. The IRS can't find people, and the IRS union person did a recent talk and said that the idea of working for the IRS is something that no one really wants to do, and it's gotten worse over time. And so they're really having trouble hiring people. Like, I'm sure you guys know this and feel it more than I do, but on Capitol Hill, the two things that come through are we have too much paper and too few workers. And that's basically what the IRS is asking Congress to do. Give them funding so they can get rid of the paper and add more workers. Now, this is from the taxpayer advocate, and I won't go through all of it because we're coming in on time, but the issue here is let's make things more automatic and reduce any sort of paper we can do. And that's basically what they're trying to do with everything. And the IRS has gotten, Congress has gotten the message. And now we just have to see what they're going to do, because the funding that the IRS got recently, which was good, was not nearly enough to what was needed. And so this money is what was supposed to happen, and it's a good amount of money, and the IRS is very happy to have it. The issue becomes it's not nearly enough. And let me go to the next slide. This is what breaks out what it's for. Now, money becomes fungible once it leaves. Like, you can appropriate this money accordingly, but in some cases it's fungible. And so, can you use it for enforcement? Can you not use it for enforcement, kind of thing? Can it go for taxpayer services instead of enforcement? They can move around the money somewhat. The problem becomes that when Congress changes hands, and it's supposed to, the GOP is going to look at this enforcement number and say, no, we're not doing that. And so they're going to say, let's do it for operation support. And so even though money can be fungible, there's limits to that. And so suddenly you could have enforcement being 0 and operation support being 10 billion. And so they have a smooth running operations with no enforcement technology. And so that's something to look out for. And I mean, even though most taxpayers would say yay for that, there does need to be revenue generated. And so one thing too that the lawmakers have noted, and this is just one of the letters that several lawmakers have sent to the IRS, saying that you need to kill all the automatic notices. You need to, i.e., get rid of the paper. And basically, what can you do to get rid of more paper so letters don't have to go out that a taxpayer responds to by letter, and it makes more paper for us. And so this is one of the things that they have tried to do is all of these automatic notices, just kill them. Which ones do you have that you haven't killed? Kill them. And the question then becomes, well, what if the taxpayer doesn't know they owe the money? Is interest and principal being added, or interest and penalty being added when they didn't know that they owed it? And so that becomes a question, at least on Capitol Hill. And the idea with the K2 and K3 forms, it really kind of showed like, you want everyone to do this? Who's going to look at it? And there's an idea that and lawmakers say this, that the IRS is broken, and they need to redo the IRS from the bottom floor up, because it's just not working. And having everyone fill out a K2 and K3, even though they have said you don't have to, the idea that they even thought of doing that is there needs to be a rethink on how the IRS does everything. And I don't know if they're ever going to get to that point. But one thing that is for sure is that whatever the improvements are going to be, it's not going to happen in this tax season. The money alone that they're going to get, this extra money alone that they're going to get, is not even going to hit the IRS until after tax season. And so what we're looking at is that it's tax season. Congress is all about tax season because all these people are talking about all these complaints. Once tax season is over, will they still think about tax season, or will they move on to the next thing? And considering there's a war in Ukraine, there's inflation going on, there's gas taxes that may or may not be cut, reduced, whatever, it makes me wonder how long IRS reform is going to be on the top of mind of lawmakers as we move into the year. And of course, when we come back next year and things are still kind of a mess, they'll be like, oh, wow, well, we need to fix this. And then it goes on and on. So, you know, how much benefit should you see from all this thing? I would just say, be pleasantly surprised if you do see something, because you may not. And it's a very slow process to get everything done. And with that, I think that's the last slide. Yes. Are there any questions?
We did see several questions come in that deal with the question of effective dates. And this is always something that is, I think, somewhat uncertain when we deal with the situation where tax legislation has hung in the balance for as long as this has. When we're talking about the extenders, even if that comes at the end of the year, in a lame duck session after the election, there is always a tendency, I think, on Congress's part to try and retroactively restore those provisions. What is less clear is what would happen with provisions that really are not so much extenders as they are new starters. And I would include in that the change, any relief from the change in the amount of interest that can be deducted. Even for that matter, the deduction of R&D expenses, and certainly anything that really is a new change. And I would include in that the potentially the SALT provisions. There's always a desire not to affect tax returns that have already been filed, which does argue, where possible, for a prospective effective date. And I think that particularly with regard to any changes that we might see in the rules for state and local tax deductibility, I would not expect those to affect 2021. I think it much more likely that be 2022. Similarly, any relief with respect to interest deduction likely would be a 2022 change, if the change is available at all. The one exception to that general thought would be the capitalization of research and experimentation expenditures. And that one does stand a very good and solid chance of being retroactive. I think most observers here in Washington think that is probably the engine that drives the extenders bill itself. And so may well be one where avoiding the necessity of really finalizing the calculations that would otherwise go into the amortization provision is something that would be seen as a positive by the members of Congress. Now, that doesn't say that it is safe to just keep on keeping on with regard and not pay any attention to the potential need to measure and capitalize research and experimentation costs. One thing to keep in mind is Section 174, the provision that would deal with that, has a slightly different definition of research and experimentation expenses than is the definition that is used for the purposes of the research credit, which of course is not affected and is not going away. So that is how if the service had to deal with the question of how concerned it is with those differences, we don't know. But again, it is the current state of the law, and is one that at least some attention needs to be paid as to whether or not proper documentation is being developed now, so that in case we do not get the relief that we're looking for, we don't have a crisis come December, January, February going forward. That is, I think, kind of covers what I saw come through, and I think we're pretty much at the conclusion of our required amount of time. If anyone has additional questions they want to send in, here are the email. Oh no, let's go back. There we go. Here are the email addresses and actual phone numbers for both myself and for Jay. And
Also,
we're always happy to be in contact. Jay wants to. Jay, please.
Yeah, one thing about the R&D thing is sometimes when lawmakers want to do something, but they don't have the legislative vehicle for it, they will send a letter. The Ways and Means Chairman and Ranking Member, Senate Finance Chairman and Ranking Member will come together, write a letter to the IRS Commissioner saying, we expect this to happen this year. That is something that some people depend on to say, okay, now I know that I can expense my R&D because these guys wrote a letter saying it's going to happen. And it allows someone to say, okay, now we know it's going to happen. And so that sort of letter might happen later this year to make sure that everyone knows, look, we're going to change this thing. Now, it doesn't mean it's going to happen, but in normal cases, when it does happen, it's usually widely reported in the tax press saying, hey, this just took place. So, if you're subscribed to Tax Notes, you would see that article, and it'd be probably a leading article if they do it.
Yeah, I think that you can count on release from our firm as well as from other firms. Of course, the one problem is, and even if we do get reliance for income tax purposes, federal income tax purposes, that is not going to constitute the acceptable reliance for generally accepted accounting principles. And so to the extent that you do have cash flow statements that are going to have to be signed, that are going to have to be prepared in accordance with GAAP, a letter of that type, while providing enormous comfort with regard to reality, does not necessarily provide any comfort with respect to the financial statement itself. Thank you again for joining us, and we look forward to touching base with you again in a quarter, in another 3 months, or certainly prior to that, if developments warrant.